Hey guys, what's up and welcome back to Econ Recaps. Morgan Stanley has downgraded the US auto sector, including major players like General Motors and Ford, citing increased competition from China as a key factor. The investment bank pointed to China's production surplus of 9 million cars, which is disrupting the competitive landscape in Western markets. As a result of the downgrade, GM stock was reduced to underweight from equal weight with a lower price target of $42 per share, while Ford was downgraded to equal weight from overweight with a new price target of $12 a share. The news caused shares of both companies to tumble, with GM falling 5% and Ford dropping 4%. Despite this setback, GM shares are still up 25% year to date. However, the same cannot be said for Ford, who's now down 15% in 2024. Disney Plus has officially launched the newest edition of its password sharing crackdown, introducing a paid extra member option for subscribers who want to share their account with someone outside their household. In the United States, adding an extra member will cost $7 per month for the basic plan and $10 per month for the ad-free premium plan. It should be noted that this rollout comes less than a month before already scheduled price hikes on October 17th. In this new option, subscribers are limited to adding only one extra member per account, and this feature is not available for Disney Bundle subscribers or those billed through a third party. The paid sharing program is now active in the United States, Canada, Costa Rica, Guatemala, Europe, and the Asia Pacific region. This move follows similar actions taken by Netflix and is part of Disney's strategy to boost revenue and profitability for Hulu, ESPN, and Disney+. Mira Murati, the Chief Technology Officer of OpenAI, has announced her departure from the company after 6.5 years. Murati briefly served as interim CEO during the tumultuous period last year when Sam Altman was ousted before being reinstated. Her exit follows a series of high-profile departures from OpenAI's leadership team, including their former chief scientist and safety director. This news comes as an anonymous leak from inside the company claims that OpenAI is considering a transition from being a non-profit company to a public benefit company, or PBC. Now, if you're like us, you've probably never heard of a PBC before. In simple terms, it's a type of for-profit business that is legally required to consider the public good when making decisions, opposed to a normal for-profit company that just focuses on increasing shareholder value. While there are numerous differences between nonprofit entities and public benefit corporations, the main differences are primarily in their ownership structure, distributions, and taxation. PBCs are still for-profit entities owned by shareholders who receive dividends, while nonprofits have no owners and must reinvest all profits back into their programs. Because of this, PBCs are taxed like traditional corporations and can raise capital through various means, whereas nonprofits are typically tax exempt and rely on donations or grants for funding. If OpenAI goes through with this plan, the rumor has it they will grant Sam Altman 7% of all outstanding shares to help ensure he's not ousted again. Looking into earnings, Jefferies Financial Group reported impressive Q3 results, with revenues reaching $1.68 billion, up 42% year over year, and net income soaring 225% to $167 million. The company's investment banking segment led the growth, with revenues increasing 47%, including record quarterly advisory revenues of $592 million. CEO Richard Handler and President Brian Friedman expressed optimism about the company's performance, highlighting strong profit margins and significant improvements in key financial metrics. This news initially shot the company up 5% in after hours before selling off as analysts had expected even stronger growth this quarter. To give this a little context, the market was expecting even higher revenue numbers and earnings per share figures, as Jefferies is already hovering around all-time highs after the stock soared over 50% in 2024. Lastly, commercial supplier Cintas Corporation reported strong Q1 2025 earnings, with revenues increasing 6.8% year over year to $2.5 billion, and net income rising 17.5% to $452 million. The company demonstrated improved profitability, with gross margins expanding to 50.1% and operating margins increasing to 22.4%. CEO Todd Schneider highlighted the company's revenue and earnings growth and noted that this quarter the company raised its dividend by almost 16%, repurchased 474 million worth of shares, and did a 4-for-1 split on September 11th. Based on these strong results, Cintas raised its outlook for full year 2025, projecting revenues between $10.2 and $10.3 billion and diluted earnings per share of $4.25. Thanks for watching, and we hope you have a great night.